Good morning, traders, and welcome to BCR's morning market analysis. First up, let's talk about the US dollar. The US dollar remained firm last week, supported by resilient labor market data and clear short-term Federal Reserve policy expectations. December non-farm payrolls rose by 50,000, which is below expectations, but the unemployment rate fell to 4.4%, reinforcing the view that the US economy is slowing gradually rather than deteriorating sharply. Weekly jobless claims edge up a bit higher, slightly to 208,000 jobs, while unannounced layoffs dropped to their lowest level since July 2024. Highlighting underlying labor market strength. The dollar index climbed above 99, reaching its highest level in nearly a month, as markets priced in a 80 to 90% probability that the Fed will keep rates unchanged at its January meeting. Technically, the index is in a short-term rebound with a medium-term downtrend consolidating between 98 to 99. Momentum indicators show improved momentum, but limited upside, with 99.32 acting as key resistance. A break below 98.35 and 98 will reopen downside towards 97.75, while a move above 99.32 and 99.82 could extend gains towards 100. Next up, let's have a look at crude oil. WTI extended its gains for a third consecutive week, trading near 58.6 per barrel, supported by escalating geopolitical risks. Market concerns intensified after renewed tensions involving Iran, further sanctions targeting buyers of Russian oil, and ongoing US actions against Venezuela, including the seizure of oil tankers. These developments have elevated supply disruptions risk across key producing regions. Despite rising US refined product inventories, geopolitical uncertainty and short-term covering provided some near-term support to oil. Technically, oil prices rebounded from 55.68, forming a short-term recovery pattern, though medium-term downturn remains intact. RSI has stabilized near neutral, and MACD signals suggest weakening bearish momentum without full trend reversal confirmation. Prices remain within a descending channel, with resistance clustered near the 60 to 60.13 dollar mark, and key support lies at 57.21, followed by 55.68 and 54.88. Next up, let's have a look at gold. Gold prices held a positive bias last week, breaking above $4,500 and reaching a yearly high near 45.17, despite a firmer US dollar and higher treasury yields. Ongoing geopolitical uncertainty and expectations for two Fed rate cuts this year continue to underpin safe haven demand. Gains were capped by Bloomberg commodity index rebalancing, which triggered short-term technical selling pressure across all precious metals. Technically, gold remains in a bull market consolidation phase following its 64.57% surge in 2025. Momentum indicators showed mixed signals, with short-term overbought pressure easing. Price action is consolidating within the $4,350 to $4,500 range. Strong support is seen at $4,400 and $4,394, while a break above $4,517 could open the way towards the all-time high of $4,549 and potentially even the next psychological level of $4,600. Next up, let's have a look at the Australian dollar, which is slightly last week, trading just below 67 cents as renewed US dollar strength and softer Australian inflation weighed on the pair. November CPI showed inflation easing to 3.4%, reducing expectations for near-term policy tightening by the RBA. In contrast, resilient US data and stable Fed rate expectations continued to support the greenback. From a technical perspective, perspective, the Australian dollar remains within an ascending channel with higher lows intact, though upside momentum has slowed. The pair faces strong resistance near 67, 66, while RSI remains in a healthy 55 to 60 range. A sustained break above 67.55, 67.66 could target the next psychological level of 68 cents and 68.52, while a move below 66.41 would likely trigger a deeper pullback towards 66 cents. Well, that's all for today's morning market analysis. As always, manage your risk and happy trading.